Hello students, this is Professor Vincent Usaga. Welcome to my class. This is part 3 of chapter 1 presentation, an introduction to assurance and financial statement auditing. We left off by talking about 3 important concepts to audit. First of all, we talk about materiality. And the second concept is audit risk. What is audit risk? We said that it is a risk that the auditor expresses in an appropriate audit opinion when the financial statements are materially misstated. What does that mean? Meaning, at the conclusion of the audit, the auditor expressed an opinion or issued a report indicating that in a layman's term, everything is okay, whereas that is not the case. In other words, auditor expressed the wrong conclusion on financial statements that are materially misstated. Remember, we talked about materiality as the first important audit concept. Now, a couple of issues that we want to look here. We want to take a look at here. The auditor standard report states that the audit provides only reasonable assurance that the financial statements do not contain material misstatements. In other words, the auditor is giving reasonable assurance, not absolute assurance, that the financial statements are not materially misstated. Reasonable assurance implies that there are some chances or some risk that a material misstatement could be present in the financial statements without the auditor uncovering it. So those important language, those languages are very important in the standard auditor's reports. Now, moving along, let's take a look at the third important concept, and that is audit evidence. Remember when we talked about the definition of audit, we said that one of the responsibilities of the auditor is to gather and evaluate a lot of evidence so that the auditor is able to ascertain a degree of correspondence between management claims or management assertions in relationship to the established criteria or generally accepted accounting principles. So the evidence helps the auditors in evaluating management assertions. Now, where does the evidence come from? Obviously, it comes from the underlying accounting data, the accounting records of the client or the auditee, their journal, their ledger, accounts, their subsidiary ledger. Internally, they have a lot of accounting records. And any other information available to the auditor, be it it could be from internal or from external source. Couple of important things that are very important here in connection with evidence. Number one, relevance. The evidence has to be relevant. That means the information or the evidence has to relate to the specific management claim that is being tested. So what does that mean? If on the balance sheet, management has a building on the balance sheet reported for $1 million, so that means it cost the company $1 million to buy the property. Now, there's a lot of assertions or claims that management is making relative to that building on the balance sheet. Now, one assertion is the company has ownership. Another assertion is the building is actually in existence. So, if you want to know whether the building is in existence, by going to the county to pull out the deeds as to who owns it, is not relevant to whether the property is in existence. for you to know whether the property is existence or not, you actually go there and drive there to see the property physical substance. So point is that if you are testing the management assertion as to ownership, then you actually go to the county to dig out the paperwork for that effect. So that evidence is related to ownership issue. And of course, the evidence has to be reliable as well. So that is another important element relative to evidence. Moving along, sampling inferences based on limited observations. We said that we do a lot of sampling in auditing. That's a situation whereby we select less than 100% of the population, test the sample, based on the result of the sample that we selected. After testing the sample that we selected, we come to a conclusion that as in connection with the whole population. So in audit, we do a lot of sampling. Why? Because it is extremely costly to audit everything or to audit every transaction, and furthermore, it is extremely time consuming. Hence, sampling is part of audit. Now let's take a look at the major phases of audit. Now, number one, client acceptance and continuance. Here's a situation whereby we embark on some audit procedures, or we actually assess whether to accept a client or not. Yes, there are a lot of reasons, as we are going to talk about eventually, as to whether we really want to accept a client or not. Sometimes it is not worth it. Now, if we have accepted a client and we continue to audit the client year in, year out, then the question is, on a yearly basis, we want to determine whether we want to continue our relationship with the client. So that is client acceptance or client continuance. The second phase is preliminary engagement activities. Those are some activities that we engage in at the preliminary stage of the audit. Then the third thing is we roll up our sleeves and actually plan the audit, because proper planning makes for an effective and efficient audit. Then after planning the audit, we consider an audit internal control. Then ultimately, we roll up our sleeves and actually dig into auditing different business processes and the related accounts of the company. Business processes, be it revenue or purchasing, payroll, so on and so forth. Then finally, we wrap up the audit, we complete the audit and evaluate the results and issue audit report. So that is the end product of our work. Moving along, like we said, at the conclusion of our work, we have to issue a report, okay? Now, the report, like we said here, it has a title, okay? And the title includes the word independent, okay? The audit report also includes an introductory paragraph, scope paragraph, opinion paragraph, and explanatory paragraph referring to the audit of internal control. We are going to talk more about this in great details eventually. The most important thing that you need to know here is the fact that there are three different types of report that we can issue. One is unqualified, the second is qualified, and the third is adverse. So now, what does that mean? Let's take a look at the first type of report. The auditor may issue an unqualified opinion. We call it unqualified opinion or unqualified report. Meaning, this is the most common report. The auditor is simply saying, in the full scheme of things, we are giving you reasonable assurance that the financial statements are not materially misstated. Quote unquote, everything is okay or it is clean. So unqualified opinion means a clean report. Now, of course, don't forget that the auditor is not giving an absolute assurance. The auditor is giving reasonably assurance that everything is okay. So that is the best unqualified opinion. Let's take a look at the second one, which is qualified opinion. Now, this opinion or report, in summary, simply states that everything is to a reasonable degree, or giving reasonable assurance that everything is okay, except, hence we are qualifying it. So explain, the auditor will likely qualify the report, explaining the financial statements are fairly stated, except for this or for that. So for example, some students will say that Professor Osaya is very detailed, thorough, he explained the subject matter very well, so on and so forth, but he makes us work too hard for our grade. So when you say but, after raving about me, you are qualifying it. Okay, so qualified opinion is not as good as unqualified opinion. Now, let's take a look at the third one, adverse opinion. Here is a situation whereby the financial statement contains a misstatement and that the auditor considered material, but the client refused to fix whatever the issue is before the financial statements are being before the audit is concluded. So the report will indicate that the financial statements are not fairly stated and should not be relied upon. Moving along, auditing demands logic, reasoning, and resourcefulness. So the auditor needs to understand more than just crunching the numbers. Okay. Here we are told that it's fundamentally logical process of thinking and reasoning, or use your common sense and reasoning skill as you learn new auditing concepts. Take some time to understand the underlying logic and how the concept interrelate with other concepts. Being a good auditor sometimes requires imagination and innovation. A lot of common sense, in other words. It is not only crunching numbers, but also actually bringing a lot of common sense into play. So that is the conclusion of chapter 1.